one of the research that I've done over the past few years is that this period looks a lot like the 1940s
Right.
rather than the 1970s. And so in the 1970s, you had high inflation, but you had very low debt. And so
Hmm.
you could raise rates sharply to try to contain that inflation. And you would cause a recession, but you wouldn't cause like a depression. You wouldn't cause like a global insolvency event. I've been talking about inflation and commodity shortages and higher commodity prices for a couple years now. And it's mostly due to the supply side. So generally, when you have these long commodity cycles, the way it works, because it's a very boom bust industry. When prices are low, nobody wants to come in and put capital into the space to start like a 5-year project for getting more metal or getting more energy. They want to either not invest at all, or they want to do smaller short term things like shale. Um, and so when you have that bear market, which we've been in, it kind of eventually creates the conditions for the next bull market because not a lot of new supply comes online. Eventually, those supplies get dwindled. Demand usually keeps growing up over time as population increases and as the developing world consumes more per capita. And eventually you get a squeeze and you get higher price and you start the next cycle. So we had that already happening under the surface. And then we also have things like ESG mandates and large divestment. You actually add fuel to that fire. And so even though oil demand has not increased very quickly in the past couple years, we've had supply shortages. And then the problem with that system is if you have a very tight market, it only takes small changes to give you pretty big price spikes or shortages. Now going forward, now that you have obviously, war in Ukraine, you have sanctions between Russia and the Western world. Russia can even pull back on some of their commodity exports. Now there's a couple big things at play. So one is that Russia is one of the biggest wheat exporters. Russia is, of course, one of the biggest energy exporters. Russia is also a large exporter of fertilizer, nickel, and other key things, including, nickel's heavily used for electric vehicle batteries and other kind of, green technologies. And so there's a lot of markets that have trouble working if you just entirely remove Russia from the equation. And so a lot of the sanctions haven't even done that. A lot of sanctions haven't even tried to remove Russian commodities because they know that Europe and the rest of the world needs them. But you still have, for example, a very unclear situation where some private entities don't want to buy Russian assets because they're not sure if they're going to be able to unload those assets for the prices they expect. They don't want to have like laws change while their ship is full of Russian oil, for example. And so you kind of had some self-sanctioning because of just lack of clarity. And so right now we're kind of adding fuel to the fire. We're getting some commodity price spikes that are unusual, but I think it's still part of a broader trend of just there's not a lot of investment, there's not a lot of new supply. Copper was already looking, rather undersupplied. Nickel already had a long-term undersupply problem. Basically, it obviously has a connection to energy in the sense that oil and gas can for example use their spare they're basically their if you collect oil out of the ground, if you have associated natural gas and you don't have a pipeline for it, you can, for example, instead of burning that natural gas into the atmosphere, you can use it to mine Bitcoin, right? So it's already a connection between energy and Bitcoin, and specifically Bitcoin mining. Now, entities that don't want to sell in dollars could sell in a number of different other payment channels. They can sell it in euros. They can trade it for gold, right? You see this sometimes in places like Iran or other countries that have to kind of go around the system. They're kind of, they're sanctioned, but there's still some trading partners that want their stuff. And so they have to make these other types of deals to go around the system. And Bitcoin as both an asset and a payment channel is obviously interesting for any sort of exporter, let alone an energy exporter. And so if the Bitcoin network continues to get bigger and more stable, it can be used for either a payment system or a store of value system for some of these larger entities. And so it's a natural fit. Fed is going to try to tighten mildly until something breaks. And even before this war, I mean, that's you had the falling PMI environment and you had the Fed try to tighten into a falling PMI environment, which is actually kind of unusual. So normally the Fed tries to tighten into a strong market. They
Yep.
say, okay, the market's strong. This is our chance to get off zero. This is our chance to stop doing QE. Um, and right now, because of high inflation, they're trying to do it, or at least talking about trying to do it, while PMIs are actually falling. And so that's kind of the big challenge. That was, pre-war, that was my big risk off concern. is all of that happening. Now, the war as another factor, because if you have high gasoline prices and high energy prices in general, that's less money that consumers can spend on other areas. And so you have this risk off environment. Now, the Fed has a dual mandate where they want to have what they call stable prices, which they define as 2% inflation based on the way that they measure inflation. And they also seek low long term employment. And right now, the employment measures they look at are pretty strong, while inflation is obviously way above their target. And that's that hurts a lot of people right now. Gasoline prices going up, wheat prices going up. The problem is a lot of that is outside of their control. I mean, they've contributed to it by having very easy money conditions, but a lot of this is due to supply things we talked about before. The Fed's not going to
Mhm.
stop tightening if markets, when indices fall 15%. They're not going to stop tightening when you just have dislocations. It's really about watching what the credit market does. Do junk bond
Mhm.
markets freeze up?
Right.
Do high yield spreads, high yield bond spreads, their yields compared to treasuries, do they widen sharply? Does that market become a liquid? Is the treasury market becoming a liquid? Those sort of things could eventually cause the Fed to reverse course and not continue tightening, and to even, say if they stop QE, they could restart QE. I still think we're a little bit while away from those. But if you do start to get severe dislocations and recession indicators, and specifically problems in the credit market, that's when I would see the Fed probably pull back. And one of the research I've done over the past few years is that this period looks a lot like the 1940s
Right.
rather than the 1970s. And so in the 1970s, you had high inflation, but you had very low debt. And so
Mhm.
you could raise rates sharply to try to
Yeah.
contain that inflation. And you would cause a recession, but you wouldn't cause like a depression. You wouldn't cause like
Right.
a global insolvency event. But in the 40s, because you had so much public debt because you were fighting the war, federal debt to GDP was over 100%. They couldn't raise rates despite the fact that they had high fiscal related, commodity war inflation. And so they said, you know what, we're going to hold rates at zero anyway, even though inflation's running hot. And so my base case has been low rates, but high inflation. And so that's what we've been seeing now. And I still think that's going to continue for a long period of time. I think the 2020s, when we look back on it, will be a decade where inflation levels were on average much higher than interest rates around the world. Right now, we're in a declining PMI environment. Most economic indicators are pointing down. Um, uh, you know, that eventually reverses one way or another. It could be that they try to do stimulus again, right? Or it could be another factor. Basically, the endless money printing kicks on again, right? So right now, when we're in this kind of trend, trends tend to be sticky until they're not, right? So until we see catalysts that this trend is changing, it's just generally a defensive environment. That doesn't mean you can't get strong counter rallies.